I've been asked several times over the past couple months to provide my thoughts on Chris Cole's Dragon portfolio. I put it off for a while, and so this is probably long overdue. I read through the publication from Artemis Capital. I'm going to summarize the main points and then talk about what I like about the portfolio and its underlying philosophy, and then I'm going to talk about some of my reservations and the potential pitfalls that everyone should be aware of. So here are the main points. The publication is told as an allegory of the hawk and the serpent. The serpent represents secular growth, whereas the hawk represents destruction, principally from inflation and deflation. It was backtested 90 years, starting with data in 1928. It suggests that the last 40 years of rising asset prices were largely due to demographic influences, such as baby boomers entering the workforce and buying lots of things with the money they earned. This period of time created many so-called geniuses whose successes were the result of luck of just being there at the right time rather than skill. It postulates that U.S. Treasury bonds have been highly profitable since 1980 due to a continuous decline in interest rates. In order to continue this performance, the yield on the 10-year Treasury will have to go strongly negative, and this is unlikely. It also says that fixed income is also likely to fail as a diversifier for stocks because rates are close to the zero bound. Bonds have been quite correlated to stocks over the past few decades. It says that with demographics shifting, there will be a tendency to need to consume capital, which will result in a failure of entitlement programs, which will result in bailouts. He believes that we're on the cusp of a secular decline where monetary authorities will do anything to prevent deflation, including what were once considered fringe policies. He considers that secular collapse is really too much debt meeting too little growth, and the only way out is deflation, which is debt default, or inflation, which is currency debasement. He says that modern portfolios are based upon recency bias. They are tailored for growth, but are ill-prepared for secular decline. He believes that pension funds are based upon the assumption of a 7.25% per year return. And if that return is not realized, then the pensions will find themselves horribly underfunded. And baby boomers may have inadequate savings if their hoped-for rates of return don't materialize. He says that strategies to generate income in a low-yield world, such as short volatility products, will not work long-term because much of the past 90 years did not include periods of time like today where such strategies work. He says that people tend to not consider that employment trends tends to correlate with the successes of assets tied to growth. A person whose job depends upon good economic times has a higher risk exposure than they are assuming when also owning assets that only perform well when the economy is growing. The other end of the spectrum is someone who only holds gold and cash because during the good times, these assets do not perform. He says that combining two assets that are negatively correlated, even if one of them loses money overall by itself, can surprisingly produce returns very similar to the assets that produce high returns by themselves, but with a fraction of the volatility. Traditional valuation metrics fail to adequately value countercyclical assets because they don't take into account how they behave in the part of the larger picture. He thinks that risky growth assets do not become undervalued in a bear market because investors are stupid, but because they lack liquid resources and they have to sell. The method suggests giving a high weight to assets that thrive during secular decline of growth assets, and these are gold, long volatility, and commodity trend. So the mixture makes up 24% domestic equity, 18% fixed income, 21% long volatility, 18% trend-following commodities, and 19% physical gold. He suggests that the equity and fixed income can be leveraged to provide the desired profit during growth periods. And these percentages were determined to be optimal since 1928. This mix returned 14.4% compounded annual rates of return from 1928 up until the year 2019. He also says that most investors chase the counter-cyclical assets, such as gold, after they have made their explosive moves, rather than positioning themselves in advance for profit. It is difficult to hold countercyclical assets when growth assets are exploding in value, especially since underperformance can last for a decade or more. But he also thinks that it's impossible to time the turning of the market cycle. So those are the main points that he made in the Artemis publication. I agree with almost all of the points made, and my investment philosophy takes most of them into account. Let me talk a little bit about the things that I like about the publication and the portfolio itself. First, he focuses on predictability of performance. I think this is incredibly important for all investors, not just institutional ones. It is very difficult, as he says, to reliably pick turning points. Oftentimes, recency bias makes investors fearful to miss out on a continuing trend. But in hanging on too long, an investor in growth assets can see their wealth considerably dwindle. Because time is the only asset that we can never get back, this makes such losses incredibly punishing. This is why countercyclical assets need to be included in a portfolio. But holding too much protection against decline also ensures that one cannot profit from the prosperous times. And so some level of balance must be struck, and it must be maintained, because the future is unknown and it is unknowable, despite how crystal clear we think our crystal balls are. Second, it is well reasoned. He gives a good justification for the portfolio construction. In theory, it makes good sense. Third, it has shown strong performance over decades. He used a 90-year window of time to demonstrate performance. This is quite different from those who cherry-pick 10 or even 20 years of time. A portfolio that has performed well for nearly a century is likely to be more reliable than a portfolio that has only performed for a handful of years. Of course, I'll talk about the problem I have with his approach to using the 90-year window of time in a moment. Lastly, he promotes using physical gold instead of gold-backed funds and derivatives. Obviously, he has some level of distrust for derivatives due to counterparty risk and due to the possibility of quotations of the paper products deviating from the underlying price of the physical metal. Now, it's curious why he doesn't mind using derivatives for commodity trend following and long volatility strategies, but I'll get to that in a moment. Here are the reservations that I have about the approach and the portfolio in general. Bear in mind, I'm not saying the portfolio is not a good one, or that it won't work in the future. I'm just pointing out what I see as the big risks so that everyone can do their own homework before considering adopting such a strategy for themselves. First, Chris Cole used a 90-year period of time to determine 5 different asset classes with 4 independent weightings. And probably 2 of those asset classes, namely long volatility and trend-following commodities, were picked out of a slew of others because they worked better than the others over this 90-year period of time. With so many parameters and choices of asset classes, I don't think that I'd be confident in the regressed weightings. 90 years just isn't long enough to have confidence. It's not like determining one weighting between 2 asset classes. Second, it ignores the changing definition of the dollars that denominate fixed income and how gold works now versus when it was part of the monetary system. Bonds now have a different character. So does gold. Next, what would it cost the average investor in commodity trend following and long volatility? Just how much would the transactions cost? How much of a drag would that place on the portfolio? What are the tax consequences? Next, he suggests in the letter leveraging the growth assets to improve returns, but also states that it's impossible to time the turning of the business cycle. So the question that I have is, if it's impossible to time the turning of the business cycle, won't adding leverage to the growth assets just amplify the risk? Next, he doesn't really go into detail about rebalancing and how it should be done. Now, this is not a drawback because maybe Chris Cole has developed a technique that he uses, or maybe he just anticipates that people are just going to hold a fixed percentage. I've found that the negative correlation between stock and gold grows over longer periods of time, and so a gradual rebalancing approach is best. Maybe he considers this, it's hard to tell, he just didn't include it in the article. Next, I have some concern about the implementation of long volatility as it requires derivatives to carry out. This means the protection of the rest of the portfolio is subject to counterparty risk at precisely the time when those counterparties will be under great stress. How he managed to backtest the strategy 90 years when modern-day derivatives have only traded for the past 40 years is really something I don't understand. But even if he was able to do so with accuracy, it ignores the impact that the emergence of derivatives markets may have had on the future effectiveness of the strategy. And finally, commodity trend suffers the same problem. The only practical way to carry it out is in the derivatives market, where there will be a significant counterparty risk. I'm curious if Chris Cole included the contango drag in his calculations of how this portion worked over the past 90-year time frame. So there are my thoughts. I think the underlying philosophy is a good one. I can't give the portfolio a thumbs down, but neither can I endorse it. I see that there are lots of things that can go wrong, at least with a couple of the components, and those pieces can fail at precisely the time when the investor will need them to perform. I also worry that this portfolio is the result of unintentional data mining. Now, I'm interested in what kind of discussion this generates in the comments section. Thanks for your attention.